My assistants would, when I worked.
Everyone, this is Rick Ackerman. Last year he was a Super Bowl in the dollar when I thought there might be, some moves the other way, and he was definitely proved out to be correct. And I believe we talked twice, didn't we, Rick?
Yes, we did, Dale.
Okay, and I saw some of the charts that you sent me, and you have a line in the sand in the U.S. dollar yen. And now that the dollar has been moving sideways since last March, you must be viewing this sideways move in the dollar as consolidation before another thrust to the upside. Are you still in that camp?
Definitely see it as corrective, Dale. I'm looking for something like 120. It tested the highs back from the early 2000s in the dollar index. We're currently trading below 100, so it's got a lot of room to move. I'm a little mystified as to why, we've got some real unwind going into some dollar-denominated assets like treasuries, but I think the dollar will eventually catch up with it, and I still think the big story for 2016 will be a strong dollar. To me, that is really the heart and soul of deflation, and I've had a deflationist perspective more or less forever.
Before we get to it, do you have a line in the sand to where the trend would change for you? Say, for example, the DXY took out 92 or 90. We're trading right around the 95 range right now. Is there anything that would change the view on the 120 target in the dollar?
Well, to confirm a bear market in the dollar index, just using my own technical system, I'd need a print down around 84.46, currently trading 95.93. So, if you look at the weekly chart of the dollar, we had a huge rally up from last July to a top in March. And since then, really, all you can see on the long-term chart is a very, at this point, prolonged consolidation.
Yeah, so it's either distribution or a continuation move. Do you have any levels? Like, for example, the euro could trade back to 120 and that could still be called a bear market rally, right? And that could take the dollar in. That could take the dollar index down to what, 92 again, or 90 before its march up to 110, 120. Is that a possibility?
I'm looking for 80 cents on the euro eventually, but the key for me, the key to the dollar index chart is that the rally into the high that occurred in December, this would have been the first week in December, the dollar index high was 100.51. And that's very crucial in my own analytical methods because it took out the previous high there that had been made in March of 2015. So everything from October to December is what I call an impulse lag, and we've been correcting it ever since. It's a bullish.
Rick, if you want, you could share your screen. You would just go up to the left-hand corner, and there's a green box. Move your cursor up to the left-hand corner, and you'll see a green box with a white arrow in it. See that up there, upper left-hand side? There, okay, now we're looking at the DXY. Okay, so now we see what you're talking about.
All right, so you can see that really there's nothing terribly bearish about this chart. We had a major rally coming from July into last spring, and ever since it's just been chopped. Yeah, but the key to me, the key to the chart really is this rally here from this low to that high, and the fact that it took out this peak right here makes this segment what I call impulsive. So just to put a couple of lines on it to show you the chart, that the pattern that I think is critical, we've got an ABC pattern right here, and it projects, well, we don't know yet that this 95.24 is going to be the low, but if it holds, then anything at above 96.92 would trigger, in theory, a long position, and I'd be looking for upside from there to at least this red line, what I call a midpoint hidden pivot. That's 98.59.
You know what? That was an important level. It kept holding 98.50, 98.50. I don't know how many times. And then when we finally took it out last week, it accelerated to the downside. So on your daily, you'll see how I kept looking at that 98.50. I thought we were going to take it out. Then the BOJ came in, and we had one more push up in the dollar that held the 98.50. And then once the yen rolled over, that was it. And so we're not sure if this is it. I mean, it could still be corrective and even retest those 92 levels again, like a big ABC, couldn't it?
It could, but right now, you know, the pattern is bullish. We've got an A and a B, which took out not only, this is what I call an internal peak, that's an external. So this is a bullish formation, and okay. It really doesn't become any less so unless this pullback takes out what I'm using as a point A low. So I gave you a kind of fail-safe number down in the 80s, but right. Yeah,
that's too big. You know, I'd have to risk my whole life getting long the dollar at 85 with a 95 stop unless I was, you know, just did it in cash without leverage.
Well, in practice, what I do, I don't wait for the weekly chart to signal me. I can come down to the 15-minute if I want and find a way to get in on a bullish side with relatively little risk. So I'm always, I'm looking at the big patterns, but I'm also watching the small ones to tell me how to trade it.
Okay. All right. I want to get to the yen because you sent me a couple of screenshots of the yen. But before that, how does a deflationist like you, who's bullish the dollar, looking for an 8 handle in the euro, explain this runaway, almost parabolic move in the gold?
Gold has a way of predicting crisis or responding to crisis, and I think that, you know, over the 4 years,
have they decoupled? Could we have a strong bull market in the dollar and gold still get to 1,1500 because the strong dollar is behind the crisis?
For sure. I don't think there'll be a dollar crisis. You know, I'm looking for strength in the dollar as a marker of deflation. And, you know, so far the most bullish thing I can see in gold's move is that it's doing it with crude oil more or less collapsing. So that's something we haven't seen ever. And it suggests that,
you know, if you have guts, I think we're at historic levels of the gold-oil ratio. It's way extreme, and contrarian trade would be to sell the gold and buy the oil. But, you know, everyone's talking about $17 oil down the road. I'm looking for maybe a recovery to 40 before that happens, if it happens. So when we take this into account, I recently have seen a sell-off in the dollar being kind of negative for the S&Ps. If we get a dollar rally, is that going to support a recovery in the stock market and trip up the bears, and we get one more high in S&Ps? Everyone's getting out down here. They get back in over 2,100 with an all clear. We go to 2,200 or so and then collapse.
Well, when I talk of the dollar, strong dollar being the big story for 2016, I mean it in the most negative way. I think a dollar rally will be catastrophic because it will actually accelerate the carry trade unwind that we've been seeing so far. You know, if you take the total derivatives market, the Bank for International Settlements estimates it at close to $1 quadrillion. If you take that, you know, implicitly it's built on positions that are either long dollars or short dollars. I don't mean explicitly, but you know, you're making a bet in any leveraged instrument that that's going to pay off for one side better if the dollar is strong and better worse if the dollar is weak for others. So so that's a big juggernaut of let's call it a deflationary overhang. And the stronger the dollar gets, of course, those people who are getting paid in their bets in dollars are doing just fine. But we really have to worry about people who are effectively short dollars in these positions. So
you mean like the emerging market economies that have all this dollar debt and their currencies have been getting crushed against the dollar?
Yeah, for sure. They would be, but the emerging market countries are not even the big players there. You know, when you talk about a quadrillion-dollar market, they're just the little guys.
So but, is it China, Rick?
China is, I'm not sure how their position would net out. You know, they were a big holder of U.S. Treasuries. That's certainly a long dollar position. You have no way of knowing what their derivative bets or hedges against that might have been. But, you know, China has also blown $1 trillion of its supposed reserves just trying to support the yuan. But so it's hard to rate China. But if you sort of look at this quadrillion-dollar derivatives juggernaut in the aggregate, it's really just a giant bundle of dollar short and dollar long positions. So I think that a strong dollar would be catastrophic. For one, it would put paid to the idea that the central banks can bull the markets around. You know, they can affect short-term rates to the extent that you get asset inflation in stocks, and you know, they can pump certain elements of components of the economy. But by and large, the strong dollar undoes all of the bets that have been predicated on up to this point infinitely available dollars. The supply has been, you know, there's really no limit to what the banks can do. We all get these emails every week. The banks are desperate to throw money at us on these 0% teaser loans. But a strong dollar is going to change all that. It's really going to be it's the market that's so big that the Fed has no control at all, even in acting in concert with all the other central banks.
Okay, so when we look at what your view is on the dollar, is it long dollar, short everything else?
Just long treasuries, and you know, they've certainly had the play so far. We had a recent high on 30-year rates up around, it was somewhere about 3.28%. My long-term forecast is 1.64%, and most immediately, I think the 30-year yields are going to come down to 2.18.
Okay, and how about for the 10-year?
The 10-year, we're already below 2%,
right.
And I think it could get down as low as 0.7%.
Okay, so therefore, you look at the yen in futures terms, and you sent me something that said that if we got through a certain level, I think it was 95 in the yen, that the bear market in the yen would be declared over.
Yeah, and it's a pretty simple idea. I look for rallies that surpass two prior peaks, one of them what I call internal, the other external. Now, the big rally on the weekly chart, the big rally in the yen has already passed the internal peak, which was 0.8631 made back on January 22nd. But the big mama peak, the really important one that the yen needs to surpass, this is basis of the March futures contract, was 0.9517 in October of 2014.
Okay, and so basically, what you're talking about is really nothing is going to thrive. Now you've thrown in just something else possibly into the mix, would be long yen along with long dollar, where do you think gold would be if we got to 120 in the Dixie?
That's an interesting question. You know, I have a long-term target in gold that makes me technically a bear. I've been looking for 814 basis the futures for a long time. But as I implied earlier, I'm always willing to look at the shorter term charts to get a trade on. And in this case, we went bullish at 1085 in the March gold contract. So so there's a kind of contradiction. But I tend to look at these things in a vacuum, not really trying to explain them. So you put the dollar index at 120. I can't see that as being bullish for gold. I think that gold will hold its purchasing power, and it will look good relative to pretty much any financial asset you could buy right now other than U.S. Treasuries. But I don't see gold being a lot higher with the dollar index at 120. I certainly don't see, $2,000 or higher gold.
Okay, and how about oil? Are you are you in the bear camp because of your deflationary viewpoint?
Yeah, I do have targets even much lower than 22. I've been at 22 since the oil last rallied into the low 60s. But there's a big problem being on the short side of crude, and that is that everybody's short crude. So you get just you get a tiny downtick in inventory or some other small bullish factor, and crude screams. Yesterday, even with the 22 target, yesterday I had my guys go long Goldman Sachs oil ETF down at 430, currently trading 460. So oil is crude is so loaded with shorts right now that it's really dangerous, even though you know where it's going.
What's your take? I know it's a little bit off subject, Rick. Are you going to be at a Bernie Sanders rally or a Donald Trump rally this political season?
Certainly not Sanders, but he's
not right enough for you?
He is definitely somebody's crazy uncle, and
Larry David.
Right, exactly. Yeah. You're not going to be able to tell the difference. But when the thing that strikes me as odd, the college crowd is all gung-ho Bernie Sanders, and mainly because he's saying, well, I'll give you free college, I'll give you free everything. But but the college crowd implicitly understands that we're already broke. If you were to ask any college kid, well, how you doing? What do you think about the Social Security system? They absolutely know that there's going to be nothing there for them when they retire. So at that level, they really know that the federal government is broke. They can't afford the Social Security system we got, and yet they're swallowing Bernie's line. But it's definitely not based on what they know and what they think.
Okay. So, Rick, you want to take this occasion to show your website and how people could get involved with you? Maybe you'll pick up some subscribers. You could show your website.
I would love to. I've got, let's see.
Because, you've never wavered, Rick, and you're still not wavering. And I could tell by the conviction in your voice that maybe it's possible this recent high we saw this week, or maybe even one more push up in the euro towards 114 or so, could be the short that takes us back under parity. I need closes back under 110 first, and then 107, and then I think you're talking under parity.
I guess you could say I haven't wavered since the late 70s. That's when I read C.V. Meyer's book, The Coming Deflation. And with that copyright date, he was obviously a little bit early. But
so was Robbie Barter.
Right. I remember his smash bestseller. But in any case, Meyer's idea was very simple. He said that in the end, ultimately, every penny of every debt will have to be paid, if not by the borrower, then by the lender. And that's really the key to deflation. The fact that some people would think very naively, well, if we get stuck, we can't pay our mortgages, we simply walk away from the house. But as you have to realize, the seller's going to pay if you do that. So there's no way to discharge that debt other than through a hyperinflation or a deflation. And what we've seen so far, there was an ugly argument for years between the inflationists and the deflationists, but the inflationists have been mighty quiet lately. And it's really because
and based upon that book and your belief structure, with all the printing that went on by not just our central bank but globally, how come we haven't been able to reflate even with all that money printing?
Well, because we've got a hugely countervailing force in the real global economy. For one, just the rise of China's manufacturing capacity has suppressed price increases from all of its competitors. So
there's just too much of everything, isn't there? And no demand.
There surely is, and you can see a lot of companies are sitting on huge cash reserves. They have nothing better to do with it than buy back their own shares, regardless of what the earnings picture looks like.
Right.
So the Fed managed to trigger off a huge financial asset inflation that's going to come to naught. But you can see even now, even the inflationists must recognize that the method of settlement, those debts, all that we owe is going to be discharged in a deflationary way. And the easiest way to get to the logic of that is to see what's going to happen with our pension system. It's virtually in a deflationary way eating us alive. Chicago just raised taxes $558 million. 92% of that is going toward pensions. So the pension disaster alone in a deflationary way is going to eat whatever the Fed can do. It's easy for the Fed to inflate markets, but just watch it try to inflate, let's say, sending pension checks out to every recipient in Chicago and New York and all the other big cities that are in a state of incipient collapse.
Even corporations, people that worked 40, 50 years for a corporation, they have pension crises. And wasn't it even exacerbated by the fact that they were pushed out to take risk instead of being able to sit in cash and get 3, 4, 5%?
Well, that's happened globally. We've when money is available to borrow for nothing, it tends to skew incentives and risk and reward perceptions. So we've had that going on globally for so long that all the players have shoveled money into things that, including their own stocks, that can't possibly be, the moves are not sustainable.
So do you think that we're going to test out the 2008, 2009 lows in the S&Ps?
Oh, I think we're going to, to put it in Dow terms, I think 12,000 will be just a start. But to me, the Dow down at 3,000 or 4,000 would be congruent with what's about to happen. We've overshot the upside targets. There've been we've gone to such extremes at Dow 18,000 that I think the correction has to be equally extreme, and it would put the Dow way below where you might think it would go if you work the numbers.
Okay, Rick, I'm still waiting for your. You may have to stop the screen share to show your website, and then
hang on.
Go back to it.
My website is, let me put it up here. I'm going to. This is my. Let's see, how do I get to?
So you screen share. You would just click wherever you're showing it on the desktop. You just click that green arrow again, and then click the box with your website on it.
Let's see here. All right.
And while you're trying to do it, what is the website address?
The website address is rickackerman.com.
Okay, that's easy.
And I am.
Do you have any free trials or anything for people to check you out, or they?
Yes, I do. If you go to rickackerman.com, at the top of the page, there's just a big free trial banner, and that will give you 2 weeks, no obligations, and just from the get-go, if you click on that and register, you'll be able to get into my chat room. It runs around the clock and draws pretty good traders from around the world. A lot of good real-time ideas in there, and the chat room is a place, very helpful place. I've got a good bunch of guys in there now, and
I believe in that. I bet that you've experienced ideas that you didn't even see that are shared by people in your community, because that's how it works for me here in the live analysis room. I've become a better trader being surrounded by traders that are better than me.
For sure, and I've got guys in here who can trade circles around me. There are a lot of good real-time ideas in the room. Also, discussion about pretty much anything. These are guys from everywhere. I've got one guy very active in the room who happens to be, he's one of those trading junkies who's up 24 hours a day. He never sleeps.
Yeah.
And he's in Albania right now, kind of struggling with the connectivity problems. But in any case, if you go to rickackerman.com, up at the top of the page, there's get a free 14-day free trial, and you'll have access not only to the chat room through a tab up top, but all of my current what I call trading touts. We've got very precise numbers for E-mini S&Ps, gold, Japanese yen, Twitter, crude oil, that Goldman oil ETF, LinkedIn, T-bonds, Amazon, silver, wheat.
What a day that was. Ever see stock lose 40-50% of its value overnight on an earnings report in a long time? That was a wake-up call.
I've been hammering on LinkedIn for a long time, mainly because as a user, I've seen evidence of something very close to fraud. You know, I would get invitations to link to people who happen to have been in my Outlook book. They couldn't have been anywhere else, but they've been, in some cases, dead for 10 years. So here I was, LinkedIn very obviously reaches into your email client, the contacts, and it filters addresses from that book. But just for the record, I think LinkedIn has more viability than Twitter, which is an outright fraud. You know, LinkedIn at least has a revenue model that's doing fairly well on the, I guess you could call it the headhunting side, the human resources side. But Twitter is an outright fraud as far as the revenue model is concerned.
I sure have a lot of, I don't know about buying the stock, but I sure enjoy using Twitter, reading Twitter. I met you on Twitter. So Twitter's been valuable to me. The corporate structure and its viability as a business, you might be right, but I'd sure hate to see it go away.
Well, it is fun, but my own Twitter following has been stuck at 12.7K for, a couple of years, and it doesn't really matter what I tweet. It's hard to get noticed unless you're Justin Bieber or Kim Kardashian, but I congratulate you for apparently getting noticed. I don't know what you're putting out, Dale, but
just being me on Twitter, buddy. But I wanted to ask you, Rick, with your outlook, what do you think life is going to be like for Americans as this economic force plays out and we have this type of carnage and deflationary depression? And why are you, and if you think anything like I do, and I do believe there's going to be plenty of social unrest, you're talking about pension failures, empty grocery stores. Are you going to stay in the U.S. and Colorado and ride it out, or do you have plans to, instead of being in the middle of it, watching it on TV from an island?
Well, I've made all kinds of pen pals, and at one extreme is a guy who lives in a compound in a spot in western Pennsylvania that he won't tell me about, and he's extreme enough that when I mention that I'm going to just stay in my suburban cul-de-sac and hunker down, he says, well, the Army Ranger in my survivalist group says that you'll need at least 2 sniper positions to properly defend a cul-de-sac. On the other end of it is a friend named Sean Broderick. He's worked for Weiss Research for a while, and he's got a book out called The Ultimate Suburban Survivalist Guide. And Sean's idea is that we're really not going to head for the hills with ammo and water rations. We're just going to kind of stay in our neighborhoods and do as best as we can, helping each other. But I think it really will come down to that. The paradigm that I put out somewhat facetiously is that we're going to be seeing people riding to the soup kitchens on their $6,000 graphite frame trail bikes. We had the Great Depression at a time when Americans, we hadn't reached the zenith of affluence, but now we have all the trappings of affluence, and it's difficult to imagine really what's going to happen with all those golf courses and $6,000 trail bikes when we're wallowing in a depression. But if you look at the slideshow, there's no reason to think that what's coming will not be worse than the experience of the 30s. You have to remember that when the economy went into depression in the 30s, approximately a third of the American labor force was connected to the agricultural economy. So we were literally living off the land at that time, and we hadn't developed this very Byzantine structure, this economic structure where people do things that most of us can't even understand. And it's hard to say, what economic value so much of what our economy is right now will hold in the worst of times. But when push comes to shove, it's just going to be, I think, the shoemakers and the plumbers and the electricians who are going to make out fine, and the mechanics. But the rest of us are going to find out that we were anything but indispensable. But we looked a lot better going into the 30s because of this factor of the economy being relatively simple. And, of course, the dollar was still sound at that time. And Americans, by and large, were more independent in the way they lived. So,
well, yeah, they had come through World War I. There were panics, the Knickerbocker. So people were used to harder times. You and I, we grew up in the sweet spot, right, where the greatest wave of prosperity in the history of mankind, in the right country to benefit from it, whether we did or not, and we're a very untested generation. So yeah, that's my concern.
I mean,
and I'm not a survivalist anyway, Rick. I wouldn't have snipers positioned. I'd say take your best shot, buddy. And what do you think? Do you think we'll still have markets to trade, Rick, or are they going to close the game down?
I think that'll all be gone. It'll resemble something like the tail end of the movie Rollover, where there's a giant trading room that is dark except for these computer monitors just blinking into the darkness. And I think that's what's going to happen to the trading world on the implosion of that quadrillion-dollar derivatives.
The exchanges are already like that. If CNBC wasn't on the NYSE floor, it would be a bowling alley. So, I mean, I went to the CME a few years ago, and the futures pits are empty. Only some action in the options pits, and that's it. So, what are we going to do for the rest of our life when we grow up?
Well, I think we may actually have to learn useful skills, Dale.
Oh my God, I'm doomed.
I'm hoping
I'll have to go into politics then, because all I have is a mouth.
Well, that's always one way to go. You could become a career politician late in life, but
how much more time does your work say we have before we're really in the soup, Rick?
Well, I've been very wrong about that. I was as much the perma bear in 1978 and 1988 as I am now, And in the 70s was the earliest kind of glimmer of disaster. I can remember reading a piece in Penthouse by a New York Times reporter named Tad Schultz, and he was talking about the third world debt and how that was going to bring us all down, and it was corroborated by an article in Foreign Affairs Digest that was talking. It put it in terms of Brazil can't cut down trees fast enough and sell resources to service the debt. And the number, as I recall, was somewhere in the 300, 400, 500. Could it have been billion? It's amazing how small the problems were we were worried about then, including the whole S&L disaster only amounted to several $100 billion. So at the time, I really lacked the imagination to see how crazy things could get. How inflated the problem could be. So we're talking about hundreds of billions then. We're finally talking about quadrillion. Yeah. So I lack the imagination then to see where things are going. Maybe I'll be proven wrong again, and we'll get to, we're going to be in the quintillion dollar neighborhood of inflation, of asset inflation. But so the question of when.
Well, Harry Dent, who's a demographic guy, says the worst of it is between now and 2022, and we don't begin to recover until 2031. So I'll be playing my harp by then.
Well, that's an
recovery.
Those dates are interesting because one of my nutty pen pals, not so nutty really, is a guy who bills himself as a Nostradamian. He was a very successful. He had a huge construction business, and he retired in his 30s, and he's made a study of Nostradamus over the years, and the Nostradamian forecast has 2 world wars occurring by your 2031 date, and also some cataclysmic geophysical events, including an earthquake that splits off California, and the famine and disease. But his scenario, even compared to the most bearish Second Great Depression scenario that I concoct, his is really bearish. And the timeline.
2032 is its timeline, with a lot of these things happening along the way.
Yeah, and the beginning of it was coincident with it's about now. But the one thing I feel pretty strongly, even though none of us is going to get the timing correct to the day, it's all one big enchilada. Everything is tied together. And although we saw and have kind of forgotten within the last couple of years that even a small bank in Portugal could bring the whole system down, that's still the case, because of the interlocking nature of this inflationary juggernaut, this quadrillion-dollar derivatives bubble. Even a small failure of a link that is linked in the way of having counterparty risk could bring the whole system down. So that whenever they stress test the European banks, and they're about to stress test U.S. banks based on negative interest rates, you got to laugh. Those guys have no better way of determining how able they'll be to cope with stress than you might as well hand the banks a slide rule and say, okay, guys, tell us what you think will happen if we get invaded by Mars. So, just a lot of hubris, really, about the banks are ready and the
banks are ready. You know what they need to stress test? That if 1,000 millionaires withdrew all their cash from their accounts from U.S. banks, that there's not enough currency to cover it because it's all digital. And that's why there's not enough cash to cover all the digital money that's been created by the banks.
I tell my guys, some of these guys are, they're gold hoarders who bury doubloons in their backyards. I tell them, whatever you think about, worthless U.S. fiat dollars, you better have a shoebox full of them ready to go, because when the system unravels, gold isn't going to work at the filling station. You're going to go and you're going to hand some guy a 1963 Roosevelt dime, and he's going to say, well, that's 10 cents, and you're going to say, well, no, this dime has actual silver in it. And the attendant's going to say, well, I don't know from silver. It looks like a dime to me. So, in that period where gold and silver worked their way into a barter economy, actual cash money, currency, $5s, $10s, $20 bills are going to have real utility because they're the only things that people who work at cash registers recognize. But and as far as not enough dollars to go around, if you go to a branch bank, as I have in the past at times, just try to take out $25,000. They don't have it. The branches don't keep much cash around. And, during the 30s, we saw people line up outside the banks. This time around, a bank might have enough money to pay the first or second person in line. So, and the obvious problem, when we get to a day when, for whatever reason, the banks don't open on Monday, the critical damage will be done. For sure, as we're discussing, you won't be able to get cash money out of the bank because they don't really keep much of it around. But the larger problem is that at that point you can see where the misplaced confidence that supports plastic money, our whole credit card system, will be gone. We won't be able to regenerate a cash economy with credit cards because the clearing system and all of the links that are implicitly trusting of each other, they won't be there. So there'll be no way to get to money other than what you have as cash. And that's why I say keep a shoebox full of 1s, 5s, 10s, and 20s, because that's what you're going to need if some Monday morning the banks don't open.
Rick, on that cheery note, I'm going to go grab a shot of tequila. And, actually, a lot of people will kind of poo-poo that. And, ignorance is bliss. I wish I didn't have these views as well for the last few decades. And to me, it's like we're in that time zone. There are a lot of great minds talking about it. Marty Armstrong I've interviewed a few times. Harry Dent. So, it's not that outrageous to talk about the fact that the whole system is going to have deep challenges going forward. And what's that saying? An ounce of prevention is worth what? Something.
Pound of flesh.
Yeah. So, Rick, I encourage people during this time zone, and plus, besides this conversation that we've had about, what might be happening down the road in the future, Rick's market calls are top shelf. They're elite. He's a great technician. So I encourage people to go to rickackerman.com and sign up for his free trial, and no risk. And I think that you're going to receive value if you paid for it, let alone a free trial to check Rick out.
Well, thanks for the kind words, Dale.
You're a brother in spirit with me. I wish you a great 2016, and I now call you, as I have before, my trading warrior brother. Keep in touch with me more than once every 6 months, and let's collaborate. And I appreciate you taking the time to be with us today, buddy.
Thanks much, Dale. Thanks for the great opportunity to connect to your large audience. It was really enjoyable talking with you.
Okay, Rick. Have a great weekend, buddy. Enjoy the 3-day holiday. China opens up Monday, and I actually think that there'll be the possibility of even one more new high to trip up every bear that's puking down here at 1800 or whatever. Everyone says 16's in the bag. I think it is, but I think first we get people to say over 2100 after they've liquidated down here at 2100. People are going to come in and say it's all clear, everything's okay. We go to 2200 and then lose 50% of market value.
Wouldn't that be something?
That's my Nostra Pinkard call. So thanks for hanging out with us today, Rick, and I really enjoyed our conversation.
Me too. Thanks again, Dale.
All right, buddy.
Bye-bye.
Everyone, that's Rick Ackerman. You could follow him at Rick Ackerman, and you could go to his website, www.rickackerman.com. Okay, you could close out the hangout anytime, Rick.